Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening and, in fact, delaying some of the reopening of the U.S. economy. Phil, you have a number of really interesting data today that shows the impact of consumer confidence, delays in reopening, and Maskwearing, and what it could mean to the overall economy. But it's still the way the second quarter closed, which was unprecedented considering the entire U.S. and most parts of the global economy shut down. And for where the market is trading right now, it really is, it's quite remarkable.
Yeah, it was pretty close to a record performance for a quarter, although obviously we sold off a huge amount in March, so we had a pretty low base to start from. In reality, the quarter went out with a little bit of a whimper. We had a very small positive move yesterday, so no real rebalancing at the end of the quarter. And I think what we're going to start turning to your point, is the fundamentals, because it's earnings season now, and all the accountants are getting their pencils back out and trying to work out what has happened to earnings in Q2. And looking at some of the analyst forecasts, you can actually see that the amount that quarter two earnings have been revised down is way more severe than what we saw for the Q1 earnings wind downs. Obviously, that's factored into the estimates. It's factored into those P numbers that we were talking about weeks ago. But it's going to be interesting to see when rubber hits the road, what the market really thinks about some of the lower earnings forecasts. And it's not just Q2, Q3, and Q4 are also wound down. So it does seem like the analysts have already started to wind back expectations of a V-shaped recovery. Potentially the swoosh is getting flatter and flatter, to your point, as we see, especially in the US, the cases start to re-expand.
Yeah, you also have some interesting data points on consumer spend, which, of course, for 2019, consumer confidence was the story, and, of course, going into the first quarter of this year prior to the COVID-19 shutdown. But I like what you have to say here about luxury spending and what that could mean for certain sectors.
Yeah, so the consumer confidence data that came out yesterday did show a bounce, which I guess was expected, but the bounce is nowhere near back to the levels that we were at. And if we sort of think back to the end of last year, sort of January, when the market hit its highs, a lot of the people had said it was consumer confidence that was helping drive the market. Global trade had slowed down. Manufacturing was already slowing down. We had the trade war, but the market kept going up, and that's because earnings kept going up because the consumer was spending, and a lot of the spending the consumer was doing was on services. What we've seen with coronavirus is services have been hurt a lot more than manufacturing by the looks of the data. And obviously, consumer confidence is well below the levels that sort of supported the market at the highs. We've completely disconnected from the performance of consumer confidence and the performance of the stock market itself, with the stock market bouncing pretty aggressively and having its own V shape. But when you dive into the consumer confidence data, it actually looked like the people on high incomes had recovered their confidence better than the people on low incomes, which may speak to who's still unemployed. But it's also in contradiction to the way spending has recovered, because other data points to the fact that those people on high incomes haven't increased their spending back to anywhere near normal levels, where some of the low income people may have been forced to, just to keep paying for rent and keep paying for food and the sort of staples. So it speaks to the different rates of recovery in the economy. It probably doesn't speak well to tourism and leisure, which is one of those sectors that we know is a sort of high risk in terms of travel and getting people comfortable to be together again and be in different places next to strangers. But it's just interesting how the conflict between what we're seeing in consumer confidence and what we're seeing in spending is playing out across industries.
Yeah, and it's also interesting. You cited some data from Goldman Sachs this morning, too, about masks and the contribution that they could potentially contribute to GDP and how much it could save us.
Yeah, we've talked about this before, where there's studies from 1918 pandemic, which showed that the states that did implement social distancing and mask wearing had a more dramatic initial slowdown in GDP, but they had a stronger bounce back in things like unemployment, and they had lower mortality rates as well. And when we're looking at some of the experience of, say, China or some of the Asian countries, even Europe now, mask wearing seems to help stop the spread, control the R, the spread number per person, of coronavirus. And so it's pretty important. There's been studies proving that mask wearing seems to reduce the chance of you catching coronavirus. So it is kind of interesting to see the explosion of cases in the southwestern states compared to some of the recent Gallup data, which shows that clearly a lot of the people in those states, based on their political persuasion, but are not nearly as keen to wear masks as in the northeastern states, where the caseloads at the moment are actually coming down. So there's a lot of data out there. There's a lot of science that proves, there's even a lot of history, recent history, that proves that mask wearing is probably going to help, not hurt, us get back to work safely and stay back at work. And so Goldman Sachs did a forecast where they actually think having masks would maybe add or at least save a reduction of 5% of GDP, which is material, especially when we're thinking about GDP being down 10 or more percent this year, at least for the current quarter and the next potential quarter. So it's not just about health. It could be about economics, being able to go back to work and stand next to people and not worry about infecting each other.
Yeah, and I'm glad that you pointed it out based on southern states, and there is some political persuasion in there in terms of mask wearing, because we're starting to see these numbers in the primaries being reflected in swing states and southern states. And this is eventually going to translate into the national election. And clearly a Trump win versus a Biden win is going to have different impacts on the market. So these are certainly things that we do have to pay attention to as market watchers.
Yeah, and this close to the election, I guess the spike in cases in a lot of those states is changing some of the dynamics of what the potential election result's going to be too. So that's adding to volatility expectations. That we've seen a little spike in November volatility because I think that there's a lot less certainty about what the election outcome will be. And it's become, in the betting markets, more likely for a Biden win. So that's just adding uncertainty to what's going to happen at the end of the year as well.
All right, Phil, thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.